I'm tired of this, Grandpa.
That's too damn bad! You keep digging! You'll thank me one day.
Hey, what's going on, guys? This is OAB with Deep Crypto. We're going to call today Media Tuesday. There's a lot of publications, there's a lot of interviews that go on a weekly basis, and I'm thinking about doing it. We'll see how this goes forward, but I'm really thinking about making Media Tuesdays and having my Tuesdays strictly delegated to all things media and what they are saying about cryptocurrency. This video is an extremely important video. You guys are going to want to stay to the end, okay? You definitely want to stay to the end. Yesterday, Gary Gensler was on Squawk Box. Yeah, he was on Squawk Box on CNBC, and he had an entire interview that a lot of people missed. So I'm going to run through that. But for those who are not familiar with who Gary Gensler is, I have something here that I was going to read about him. And then we'll go right into the interview. I'll probably pause some things, potentially, or I may just let him talk. We'll just see what he's saying. And if I have some input, I'll make sure I bring it in. But who is Gary Gensler? Gary Gensler is the current chair of the U.S. Security and Exchange Commission, the SEC. He was nominated by Joe Biden on February 3rd, 2021, and confirmed on April 14th, 2021. And he was sworn into office April 17th, 2021. Prior to his current position, Gensler was a professor at MIT Sloan School of Management, and former chair of the U.S. Commodity Futures Trading Commission, the CFTC. Gensler leads the SEC in its efforts to maintain fair, orderly, and efficient markets, to facilitate capital formation, and to protect investors and build public trust in the market. Let me stop here. If you guys would like to comment about your thoughts about Gary Gensler and this process going on with the SEC and the Ripple case, feel free to leave those comments in the comment section. I will definitely be reading all your comments. Going forward with the article, Gensler has a significant portion of his career working in government. Most recently, he led Biden's transition team in its planning of financial industry oversight as chair of the CFTC from 2009 to 2014. Gensler was known for his tough enforcement of rules regulating swaps trading following the 2008 financial crisis. So when Gensler comes into play, seems like there's a financial crisis on the rise. Gensler has extensive experience aside from his work with the CFTC. He was a senior advisor to U.S. Senator Paul Sarbanes in writing the Sarbanes-Oxley Act of 2002. So he was a part of SOX. During the Clinton administration, he served in posts as Assistant Secretary of the Treasury and Undersecretary of the Treasury for Domestic Finance. So he's a well-known name with the U.S. Department of Treasury. Gensler was awarded the Treasury's highest honor, the Alexander Hamilton Award, for his service. His most recent position before becoming SEC chair was a professor of the practice of global economics and management at the MIT Sloan School of Management and co-director of MIT's FinTech at CSAIL. During this time, Gensler got a first-hand perspective into the functioning of cryptocurrencies and blockchain. Both technologies are supposed to revolutionize the financial service industry. Because he has an understanding of the intricacies of regulation and fintech, Gensler is often viewed as an intermediary in both worlds. So Gary Gensler is the XRP between two worlds. For his part, the SEC chief has said that he is in favor of more oversight of the cryptocurrency industry to achieve public policy goals. Gensler's work with the CFTC has given him a reputation as a tough regulator, and he is likely to please progressives with a hard-nosed approach to Wall Street. He is viewed as likely to advance rules that address key democratic policies such as social justice and climate change, including requiring greater corporate disclosure about the risk related to the latter. All right, so that's what I have as far as this article here from Investopedia talking about Gary Gensler. Let's take a look at this interview that he did yesterday, January 10th, on Squawk Box on CNBC.
Welcome back to Squawk Box this morning. I want to get to our next big interview of the morning, and this one has implications for investors from Wall Street to Main Street. Joining us right now to talk about his regulation agenda and top priorities in the new year, SEC Chair Gary Gensler. Mr. Chairman, it's great to see you this morning. We are coming up on the anniversary, in fact, of the GameStop saga. And as you lay out your priorities this year, whether it be crypto, whether it be compensation plans, climate and the like, what would be the number one thing you think you would look back on if we had this conversation next year that you hope to accomplish?
Well, Andrew and Becky, good to be with you. I think about updating our markets for these 2020s. It's 2022. Technology is rapidly changing. So I think of in light of that, in light of the rapid changes in technology, how do we ensure that our markets continue to be the most efficient in the market? That means the lowest cost, and that's the lowest cost for companies and individuals raising money in the market. And it means lower cost and thus better returns for investors. And having efficient markets in the middle for companies on the one hand and people on the other side in rapidly changing technology. That's what we're trying to accomplish.
There's lots of pieces to that. Let me start this morning with this. There's a story in the Wall Street Journal today saying that the SEC pushing for more transparency from private companies. That has become a increasing feature, if you will, of the market or marketplace. And I'm curious if you could comment on that and what it means. Are you going to make it harder to become a quote-unquote accredited investor? Are you going to make more disclosures required of private companies? This becomes quite complicated because especially in this meme era, one of the things we're hearing from folks is that they want more access to private companies.
First thing we have to understand is that the United States is a corporation and it is a private company. The Federal Reserve Bank is a private company. Police forces are private companies. The government is a private company. Congress is a private company. And being that these are companies, these corporations, their goal is to make money. Or in this instance, since they don't provide a service, in reality, their goal is to take money. Which is why we heard the rumor, which may not be a rumor in the near future, about them taxing our capital gains. As we continue to listen to Gary Gensler, what we want to do is be mindful. We want to be intelligent when we're listening to things in the media. So just get that in mind, that the real private company is the government.
Well, I'm glad you asked that. Look, we've long had both public companies and private companies. And we have said if you want to tap into the broad public, there's a basic bargain. Share information, disclose information that's important to that investor.
Disclosure, disclosure, disclosure. One of the most important things for any contract is to have full disclosure of both parties that are taking place within the contract, within the agreement. Disclosure, 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 because that's the only way you can assure that someone isn't defrauded.
And don't defraud them. a disclosure and an anti-fraud. Don't lie, basically. That's our basic bargain in the capital markets. We are going to take up, again, a project around driving greater competition and efficiency in the private fund space. These are the funds that raise money. The total number is about $17 trillion, raise money from pension funds and also from wealthy individuals. But those pension funds are our money. It's individuals' money in pension funds, raise money, and then invest in the capital markets.
If you guys wasn't aware, this little small clip I wanted to add in, and then I'm gonna go right back to Gary Gensler, was from Robert Kiyosaki, and he was talking about pension funds and the big time fraud that took place with the pension funds. This coincides with what Gary Gensler is talking about, trying to bring forth some statutes, quote unquote laws, to protect investors or people who put money into these IRAs and 401ks and such going forward.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news today about pensions. You can listen to Rich Dad Radio anytime on iTunes, Android, and now we're on Rumble and Locals and all this other stuff, because we'll probably get taken down every other week because our freedom of speech has been denied. And all of our programs are archived at richdadradio.com. We archive them for one reason. We sell nothing. We make no recommendations. We're a pure education company. And one of the best ways you'll learn is by listening to things once or twice, because repetition is how we learn. Like, you don't become a great golfer taking one drive off the tee. You keep practicing. So go to richdadradio.com, especially if you have friends, family members, and business associates, and especially if they're counting on their pension. Or you are in a 401k counting on the stock market keep going up, or you bought real estate hoping it goes up, or you have gold, silver, and Bitcoin hoping it keeps going up. Because I have bad news for you. This notice here, the retirement fund giant CalPERS, I think it's the biggest in the world. If they go bust because they're using riskier alternative assets is the wrong word for that. It's collateral. What is of value? Who's the counterparty in this whole thing? Who are they counting on to pay in case the asset goes bad? That's what it's, if the asset. So like if gold goes bad, you don't have to worry about it because the counterparty to gold and silver is God. And the counterparty to like Bitcoin is the network and the people. You're not dependent upon the Fed. The problem with a dollar is dependent upon the Federal Reserve Bank, and the problem with stocks is based upon those criminals in Wall Street. And that's why I have no shares in the stock market. I've taken companies public. I know what goes into a share. I don't trust them. Now, John is the expert at it because he's on the financial planning side. So that's why he's one of the Rich Dad advisors, because most people should be in stocks, bonds, mutual funds, and ETFs. With that said, we'll go into, what was the question?
So I had a question. We're seeing a ton of, in these different municipalities around the country that are implementing vaccine mandates for a lot of their city workers, fire, police. Exactly. So we're seeing that a lot of them are taking early retirement or leaving, their post. So my question is, does that have any immediate impact to these pensions? Does that accelerate the problems that we are seeing?
John, what's your answer to that? Because you're the expert on that.
Yeah, it's a great question, Sarah. And these plans are now going to face even increasing pressure to generate performance, as I said earlier, because as more people leave the plan, that's less money going into the fund. And as those people leave, they're also pulling their money out for their pension. So it's a double-edged sword on these plans. Now we've got, as I said, 10,000 people hitting 65 every single day. That's a lot of people retiring. On top of that, add COVID and all those people that refuse to get vaccinated for whatever reason, they're being forced out of their employment as well. So it's a huge drain and strain on these funds.
So Ted, as the expert on funds, and Ted's a former SEC attorney who makes his money suing these guys for their incompetence. I'm glad you do that, because as all the years we've worked together, Ted always reminds me of the criminals who are now in public office, and they don't represent the people, they represent Wall Street. If you know that, you'll know why Ted's job is important, to keep them honest. So Ted, what do you think this COVID thing or mandates and shutdowns, how is that going to affect pensions?
Well, I'm not sure.
Hi, this is Robert Kiyosaki, and I want to talk to you about an opportunity to learn to be an entrepreneur on the internet. And let me tell you something.
Well, I'm not sure how it's going to affect pensions. I mean, as some people leave, younger workers may come in. Very hard. I wouldn't really have a firm answer for you on what the impact of COVID will be on pensions.
Okay.
John may have another view on that.
So let me ask you this question. The big question is, what do you do?
Exactly.
Because even if you don't have a pension in CalPERS, this is like the asteroid strike in the middle of the Pacific Ocean. There's going to be a wave so big, because this is not going to affect just money and markets and real estate and things like that. It's going to affect lives, big lives. Like I said, my classmates I went to flight school with, they lost their pensions. There's a thing called PBGC, Pension Benefit Guarantee Corporation. And John mentioned something most people miss. It's a 7% return. So let's start with 7% return. What does that mean to you, John, when they say they got 7%?
Well, that's the target that these funds set for themselves in order to make their obligations to their employees that are retiring. They need to hit that certain target market based on the actuarial assumptions that they've created. It's an arbitrary number. It's really a number that they're hoping to reach for. And it's nearly impossible in this environment when we have a stock market at an all-time high and interest rates at an all-time low. Hitting 7% on a consistent basis is very difficult, which is why CalPERS just lowered their target return from 7% to 6.8%, because they know they can't hit it. And that's why they're stretching with more riskier assets. That's the challenge.
Yeah. And the problem with that word asset is, my definition is something to put money in your pocket. And these assets these guys are so-called buying to make the 7% are going to collapse. That's the problem, because there's nothing behind them. The counterparty is a crook. The person that's guaranteeing the asset is going to disappear. So that's why there's so much to understand. What's that?
Yeah, I'll just add to that, Robert. I can't tell you how many individuals I've worked with that have pensions, and I'll show them how underfunded their specific pension fund is, and they'll say, it's guaranteed. It's in writing. They promised me that benefit. And I'll tell you, it's a very hard conversation to get people to realize. That law changed in 2014, where now pensions can, under the law, cut benefits when they can prove they're under financial distress. Most people don't realize that. And we're already seeing, and Ted could add to this a lot more than I could, we're already seeing pension benefits already in place being slashed. If there's no money, there's no money. I don't care how well written that guarantee is.
So Ted, would you briefly explain what the PBGC stands for?
Yeah, the PBGC is the Pension Benefit Guarantee Corporation. That is supposed to be the backstop for all corporate pensions, not public pensions, but corporate pensions. But the PBGC is substantially underfunded. Last I heard, it was about $54 billion underfunded. So the federal agency established to bail out pensions needs a bailout.
And there's about $300+ billion a year in fees in these funds. And we're going to see if we can propose some rules to drive more transparency and competition in that important part of our investing capital markets.
How do you feel about the increase in crowdfunding that's happening online, increasingly with various cryptocurrencies and coins? I'm thinking of the Constitution DOA project that happened earlier this year to raise money to effectively bid on the Constitution. That group ultimately lost, and those investors in it ultimately lost at least some money.
Well, Andrew, you don't understand why I won't maybe comment on any one project, but you raise an interesting point. Crypto tokens, I will call them, are raising money from the public. And are they sharing with the public the same sets of disclosures that helps the public decide? And are they complying with our sort of truth in advertising? Call it the Securities Act anti-fraud provisions. And so there's thousands of these projects. You named one, but there are thousands of these projects basically trying to raise money from the public so that they can back an entrepreneurial idea. Well, that part's That part's all right. That, in fact, is called innovation. But it's about bringing it into the securities laws. And unfortunately, way too many of these are trying to say, well, we're not a security. We're just something else. And I think that the facts and circumstances suggest they're investment contracts, they're securities, and they should register.
There are plenty of cryptocurrency projects that try to be tricky, try to use some type of legal language to get around the laws. But what we know as far as the Congress and the company that is the government, they just create any kind of statutes at any given time, which the public tend to adhere to. So although currently now that these cryptocurrencies are abiding by the current language and bypassing those laws, in the future, all they have to do is change something up, and then all of your investment will be gone in an instant. So that's why they say that 99% of cryptos are going to go straight to zero, and you want to be a part of those that have real world use case due to CEOs or centralized entities that run these coins trying to get around the laws the best way they can so they can make all their money that they're making now.
We had a lot of viewers sending questions, and one which relates to this issue is, can you explain your view of whether Ethereum is a security or not? I think you've actually suggested it isn't, but then why you believe that Ripple is a security. And I know there's an ongoing lawsuit related to Ripple, but could you speak to the Ethereum issue?
Andrew, just to have a little fun with you, refer back to my earlier question. I'm not going to speak to any one matter, and so your listeners understand it. I'm the chair of a 5-member commission that's also a civil law enforcement agency. And so we don't get involved in these types of public forums talking about any one project, one possible circumstance, and give legal advice over the airways that way. But again, let me talk about more generically the overall market. If you're raising money from the public, and the public is an anticipation of profit based upon that promoter, sponsor, that group's efforts, that's within the securities laws. And it's within the securities laws because Congress painted with a broad brush. They wanted to protect you, the investing public, so that you have proper information, or what's called full and fair information, and protect you against fraud and scammers and the like. It's a simple, basic idea. You get to decide whether you want to invest in this security or that security, and if they call themselves a token, they're still probably, possibly a security. You get to decide, but there needs to be some basic disclosures and protection against lies and frauds.
Chair Gensler, this sounds like a pretty important distinction and maybe a new way of thinking of these markets. This is kind of a new broad framework that would open the way for the SEC to maybe have a lot more say over a lot of arenas. And you start thinking about all the different ways investors, I mean, I'm just going back a year to where we were a year ago at this point. It was SPACs that were the huge rage that everybody was kind of interested in, and the new way of taking a company public through these acquisition vehicles. And what you're talking about is making sure that you are looking at broad protections, because there are so many retail investors that are maybe investing in a different way than they had in the past. Is that kind of what we're listening to here? This sounds like a fairly important statement.
It is important. Part of it's new and part of it's old. It's like that old saying about when one gets married. So the new part is the new technology, whether it's crypto tokens, whether it's special purpose acquisition companies or SPACs. These are something new. There are new ways to trade on the markets through brokerage apps and robo-advisors and like. That's what's new. But what's kind of old and really important is this basic idea that if you raise money from the public and the public's thinking about a profit, you've got to give them basic disclosures and everything. And that goes back to the 1930s. It goes back to when the Supreme Court defined this test in 1946. That's the important public policy thing that we should not be neutral to. And then the technologies come along and they promote innovation, whether it's crypto, whether it's a new form of doing initial public offerings through these SPACs. That's exciting. Our role at the SEC is to ensure that you, the public, still gets the basic protections.
If I'm the industry, though, I hear that as you guys are laying the groundwork for getting involved in a lot of areas that you maybe hadn't been necessarily closely involved in the past. This is the justification for why you are going to be overseeing all of these different arenas. Is that an unfair
Becky,
assessment?
I beg to just differ with that description.
Yeah.
The SEC has been involved in these arenas since the 1930s. It's been updated. Our laws have been updated often, and staying within that framework, those public policy frameworks of the public gets to decide, but we try to have basic disclosures and protect the public. New technologies come along, and sometimes industry is trying to find what they might think ways around these basic protections. They might be finding ways to, quote, arbitrage the system.
Hey, Gary, I'm going to go rapid fire with you on a handful of other issues before we close out this segment. There's been a number of massive insider trades. This is not insider trading per se, but CEOs who've been selling. You've been trying to update the 10b-15 program in terms of how they're able to do that. I wanted to ask you actually not about them so much as about Congress. Nancy Pelosi was recently asked whether members of Congress should be able to buy and sell individual stocks. She made the case that they should. And I don't know if we've ever asked you directly. Do you believe that Congress members should, given the information that they often are in possession of? And have you thought about any form of additional regulation from the SEC?
What?
I'm going to preface this by saying allegedly. Allegedly, Congress and Congress members have been insider trading for years now. And allegedly, Gary Gensler's brother, I believe he has a twin brother, is also intertwined with a bit of insider trading. So that's just alleged. You guys can do your own research to figure that piece out, but they all are a part of this game. They all are working for the United States company, and that's pretty much that. Make sure that you guys have pressed that subscribe button by now. This is one of my most important videos. Like, subscribe. I would prefer you do not share on your social medias, okay? If you want to direct somebody else to this page, feel free to do so. Tell them to like and subscribe as well, because I'm going to give so much financial information that a lot of other channels are not doing, because here we are actually digging deep into crypto.
It's interesting, Andrew. There's a law that Congress passed not that many years ago called the Stocks Act, and it was it addressed this issue. It addressed this issue about the use of material non-public information, and sometimes that non-public information is inside a company, but that non-public information can also be inside of the deliberations and discussions in the legislative branch. And so Congress did address that, and we're the agency that has some oversight there, and we're going to vigorously enforce that law, which is, I'm sorry, it's maybe 10 years old.
But you have no concerns about the credibility of Congress, the credibility of corporations that oftentimes are talking to members of Congress when it comes to these issues?
I think that our whole system of finance comes down to one basic word, and it's called trust. And it comes back to Becky's earlier question and your current question. How do we get the best trust so companies can raise money efficiently and investors can, quote, trust the market? And protecting against insider trading, whether it's at a company or whether it's a government official, both are important to the basic trust.
Talking about trust, a lot of questions among American investors about whether they should be investing in Chinese companies at a time where we're seeing massive shifts in the way the Chinese government is regulating their own companies. What's your thought about that and how the American public should think about it?
So we've got about 250, 270 companies that are related to China in the U.S. capital markets. And we've got a couple of challenges right now. One is that the Chinese officials for about 19 years have yet to sort of let the auditors of these companies, the accountants, be inspected. And we have a law that was passed in 2002, Senator Paul Sarbanes and Mike Oxley, a bipartisan bill that says the auditors, the accountants, have to be open to inspection. 50 countries have allowed that. China has not.
Ha! I like to laugh at that.
And so that's one challenge. Another challenge is that, as you said, some things are really changing rapidly in China in terms of some of their big tech and other companies. And so what disclosures are the public getting? What disclosures are they getting, particularly since they're usually not buying? Again, listen, just listen to this for a moment. You're usually not buying the company in China. You're buying a company in the Cayman Islands that doesn't even own the company in China. The company in the Cayman Islands often just has a contract to operate that company in China. So we at the SEC have a couple of projects. One is to enhance the disclosure around these so-called variable interest entities, the Cayman Island companies. And two, to implement a law Congress passed just a year ago that gave a clock, a 3-year clock, right, to say, come into compliance with these inspect the auditor regimes.
Chairman Gensler, we want to thank you for joining us. We look forward to talking to you again. There's so many issues that we haven't got into. I want to talk to you about climate and dark pools and meme stocks and so much more. I hope to get to those the next time we have an opportunity to speak. Thank you.
All right. Thank you, Becky. Thank you, Andrew. Thank you for all your listeners.
I'm tired of this, Grandpa.
That's too damn bad! You keep digging! You'll thank me one day.